Well, there's been a lot of talk lately about what happens if this Iran deadline actually runs out, whether this is one more dramatic bluff, whether it turns into a much bigger regional strike cycle, and whether the next headline changes not just the war story, but oil, gold, silver, food, inflation, and the global money system all at once. So in this video, we're going to separate fact from fiction, and you are going to walk away feeling a lot more clear on what actually matters, what probably does not, and where the real risks are hiding. It's Wednesday, April 8th, here in New York, and before we go any further, comment what day and date you're watching from. And quick note, if you value this kind of work, subscribe and comment John A.G. Best so I know you're here. So in case you haven't seen the type of chatter I'm talking about, it's the same basic idea showing up in slightly different clothes all day long. The deadline expires tonight. The White House language gets hotter. Iran says it will not fold under threat. The Strait becomes the center of the world. Oil is supposed to explode. Gold is supposed to launch. Silver is supposed to follow. Food is supposed to get squeezed. The dollar is supposed to crack. And by tomorrow morning, according to the loudest voices, the whole map is different. Now, some of that is grounded in reality. Some of it is interpretation. And some of it is people taking one scary headline, stacking 5 assumptions on top of it, and calling that analysis. That is where we have to slow down, take this apart piece by piece, and ask a much more useful question. Not just, could this get worse? Of course it could. The better question is, what kind of worsening are we actually talking about? What travels fast? What travels slow? And what breaks first if this thing slips further? Because if you start there, a lot of the noise immediately falls away. First, let's talk about the mood of the moment. Yes, it is tense. Yes, the language has been severe. Yes, there has been a real sense that one decision could push this from ugly to much uglier very quickly. And yes, there were reports over the last day that the United States was prepared to intensify attacks if no arrangement was reached by the deadline, while more recent reporting says a temporary pause was agreed to at the last minute, tied to safe passage through Hormuz and more talks ahead. That matters, but not because it means the danger is gone. It matters because it proves how fluid this has been hour to hour, and why anyone pretending this is a straight-line story is probably fooling themselves. And that leads to the first major point. The most dramatic public threat is not always the most realistic military outcome. A lot of people hear maximal language and immediately picture total destruction. I don't. Not because the situation is safe, but because even powerful militaries still operate inside real limits. There is a huge difference between saying, we can inflict pain, and saying, we can erase a country's ability to function on demand. Those are not the same sentence. They are not the same objective. They are not even the same universe. So what is more likely if escalation resumes after a pause like this? In my view, the most likely path is not some neat movie ending. It is calibrated damage with maximum political theater attached to it. In other words, targets that are visible, targets that photograph well, targets that let one side say, look what we can reach, without necessarily proving that they solved the underlying problem. That can include bridges, transport links, power assets, energy nodes, logistics pieces, the kind of infrastructure where the image of the strike does half the work. And that distinction matters because television damage and strategic damage are not always equal. A bridge in pieces is instantly understood by the public. A damaged processing train inside a large industrial complex is not. A blown transmission tower is visually legible. A hit to some specialized unit that takes months to replace may be more important, but it does not announce itself the same way. So when people talk about what gets targeted in an environment like this, optics are not some side issue. Optics are part of the targeting logic. Now here is where I want to challenge one of the implied assumptions behind a lot of the panic. People are speaking as if any renewed strike automatically proves one side has regained total control of the escalation ladder. I don't buy that. You can launch a strike without owning the next 10 moves. In fact, one of the biggest tells in moments like this is when rhetoric keeps getting more dramatic because the earlier rhetoric stopped moving people. Markets get used to threats, governments get used to warnings, audiences get numb. And when words start losing force, the temptation is to act just enough to restore credibility. Not necessarily to win outright, not necessarily to solve the whole thing, but to show that the warning was not empty. That is a very different kind of danger, because a limited action meant to restore credibility can still trigger an unlimited chain of consequences if the other side interprets the public version of events more seriously than the private version. One side may say through quiet channels, we only hit this much. But if the public messaging is, we crushed you, the reply may be aimed at the public message, not the private reassurance. And that is how situations overshoot. Now let's flip to Iran's side of this, because that is where the second-order risk really starts. I think a lot of Western commentary still slips into a bad habit here. It assumes retaliation is optional. I don't think it is. I think once you reach this level of rhetoric, strike history, and domestic pressure, retaliation becomes part of the logic, whether leaders love that logic or not. You may get delay, you may get calibration, you may get proxy action, direct action, or infrastructure pressure instead of a symmetrical military answer. But the idea that visible humiliation would simply be absorbed and forgotten, I think that is one of the weaker reads on the board. And if there is retaliation, it does not have to be one for one to matter. This is where the conversation gets serious, because the most meaningful reply may not be the one that creates the biggest blast on social media tonight. It may be the one that interferes with the arteries of trade, shipping insurance, refining, power supply, desalination, or petrochemicals across the wider Gulf. You do not need to shut everything everywhere to create a real economic bruise. You only need to make enough of the system unreliable that freight costs jump, refiners hesitate, buyers pay up, and planners stop trusting their timetables. That is why the Strait of Hormuz is so important, and also why it is often discussed too simplistically. People talk about Hormuz like it is a light switch, open or closed, on or off. I don't think that's the right way to think about it. It is more like a narrow hallway where uncertainty itself can become a weapon. Maybe some cargo moves. Maybe some ships are waved through. Maybe some buyers feel comfortable and others do not. Maybe insurers reprice the route. Maybe certain vessels get priority while others wait. You do not need a perfect blockade to create a market shock. You just need enough friction in the wrong place. And based on the latest official energy outlooks, the market is already treating that risk as real. U.S. energy forecasters said this week that crude averaged a little above $100 in March, that disruptions tied to Hormuz are expected to keep a war premium in place, and that output losses could still be substantial into late spring even under assumptions that traffic gradually resumes. They also cut their view of global oil demand growth this year because shortages and forced conservation are already altering behavior, especially in Asia. That tells you something important. Even the optimistic scenario now starts from damage, not from normal. And here is the part many people miss. Futures can move in seconds. Physical markets cannot heal in seconds. So yes, you can get a relief headline and oil can dump hard in an afternoon. We just saw that. But at the same time, recent market reporting says physical crude and fuel markets remain tight. Buyers are still paying extreme premiums for certain barrels, and producers have pushed some official selling prices to record spreads because actual prompt supply is still stressed. In plain English, paper can relax before plumbing does. That is why a ceasefire headline can calm the screen while the real economy still limps. And once you understand that, the diesel conversation makes a lot more sense. And this is also why early battle reporting needs to be handled with a lot of humility. In the first wave after any strike, you are usually not getting clean information. You are getting fragments, incentives, spin, and imagery without context. One side wants to show strength, the other side wants to show resilience. Commentators want to sound decisive before the facts are settled. Markets do the same thing. They price the rumor, reverse on the clarification, then reprice the second-order effect nobody bothered to think through the first time. So when people ask, what was actually hit? That is not a small question. That is the question. Was it symbolic? Was it operationally meaningful? Was it expensive to repair but not systemically important? Or was it one of those quiet components that does not look dramatic on camera, but jams the supply chain for weeks? Those are different worlds. This is where I think a lot of investors make a mistake. They focus on the violence itself, but not on replacement time. In industrial systems, replacement time can matter more than the blast radius. A damaged runway can be patched one way. A niche compressor, a specialized turbine part, a grid transformer, or a refinery component with a long lead time is a different animal altogether. And once buyers realize that lead times are stretching, they begin front-loading orders, which can create scarcity that feels bigger than the original damage. We have already seen versions of that in energy commentary this week. Even with hopes of de-escalation, analysts have warned that restarting damaged production is not instant, that labor availability is a constraint, that shippers remain cautious, and that some Asian buyers are still scrambling for replacement barrels and fuel. That is why the phrase temporary ceasefire does not automatically translate into temporary economic effect. A pause in shooting and a return to normal are not synonyms. There is another subtle point here too. Higher oil does not only hit consumers at the pump, it changes corporate behavior. It changes inventory behavior. It changes hedging behavior. It changes which businesses can absorb input costs and which cannot. It changes who can finance working capital and who gets squeezed out. In that sense, an energy shock is not just inflationary. It is also selective. It redistributes pressure unevenly. And that connects back to why I think some people are too quick to jump straight from war risk to gold and silver to the moon right now. Maybe eventually. But the bridge between those 2 points can be ugly. If oil spikes, rate cut expectations can get delayed. If rate cuts get delayed, the dollar can stay firmer than metals bulls expect. If the dollar stays firmer, gold can wobble even while the long-term reserve argument gets stronger underneath. That is exactly the kind of contradiction that traps people who only know one story at a time. By the way, that contradiction is not theoretical. Recent market coverage showed gold acting less like a perfect crisis hedge and more like a battlefield between safe haven demand on one side and higher rate pressure on the other. That is why I keep saying this is a two-speed market. The tactical trade and the strategic thesis are not always synchronized, because diesel is not a glamorous topic. It does not trend the way gold does. But diesel sits inside almost everything: moving goods, moving crops, running heavy machinery, supporting mining, supporting construction, supporting freight. When diesel gets tight, the effect does not always arrive as one obvious crisis label. It arrives as 1,000 smaller headaches at once, all of them more expensive than they were supposed to be. That is also why the food conversation is not crazy, but it does need to be handled carefully. I do not think the smartest framing is, the shelves everywhere are about to go empty tomorrow. That is too crude. The better framing is this: energy and fertilizer shocks do not land evenly. Richer countries often experience the first wave as higher prices, thinner margins, and ugly substitutions. Poorer countries can experience the same shock as outright shortage, delayed shipments, underapplication of fertilizer, and real nutritional stress. Recent food agency updates already show food prices rising again on higher energy costs, and separate updates show fertilizer markets spiking sharply in the aftermath of the regional disruption, with some urea benchmarks jumping by roughly half in a month. That does not guarantee a famine spiral, but it absolutely means the stress channels are real. And notice how that fits with the broader agricultural backdrop. U.S. farm input reports from the last few months have shown diesel and some feed costs firming again, while global agencies have been warning that even where grain supply looks broadly adequate, fertilizer and energy remain the wild cards. So this is not just an oil story. It is an input cost story, a transport story, a margin story, and then eventually, if it runs long enough, a food access story. Now let's bring gold and silver into this, because this is where people get emotionally sloppy. A lot of investors still carry a cartoon version of how precious metals react to war. They think war headline equals metals up instantly, in a straight line, no interruptions, no liquidation, no cross currents. That is not how real markets work. In a genuine shock, especially one that hits growth, rates, the dollar, and liquidity all at once, gold and silver can absolutely get sold first along with everything else. Not because the long-term thesis disappeared, but because in the short term, people sell what they can, not just what they want to. And recent price action has already reminded people of that. Gold sold off hard in March, even with geopolitical chaos in the background, then rebounded strongly this week after the temporary pause changed the near-term inflation and rate narrative again. In other words, the market has been trading not just fear, but also real rate expectations, the dollar, and forced positioning. So if somebody tells you gold has to behave one way every hour of the day, I would be very careful with that person. That said, the medium-term gold story is still very hard to dismiss. Why? Because underneath the volatility, the official sector bid has not gone away. Gold demand last year broke records on a total basis. Investment demand surged. Exchange-traded fund demand was the strongest in years. Central bank buying stayed historically heavy. And just this week, we learned China extended its official gold buying streak again into a 17th straight month. At the same time, the European Central Bank has already acknowledged that, at market prices, gold became the second largest global reserve asset recently, behind only the dollar. That is not a fringe development. That is a structural statement. So when people say, is gold only moving because of one war? No. A war can accelerate the move. A war can interrupt the move. A war can temporarily distort the move. But the deeper move has been building for a while now through reserve diversification, fiscal anxiety, geopolitical fragmentation, and repeated central bank accumulation. Silver is more complicated, which is exactly why it gets interesting. On the bullish side, yes, silver still has a monetary shadow. When gold gets revalued higher in a disorderly world, silver often gets dragged upward with it, eventually. Yes, silver is still tied to electrification, electronics, grid spending, and advanced manufacturing. Yes, military technology, sensors, connectivity, and data-heavy infrastructure are not exactly silver negative. And yes, recent industry outlooks still show the market in another sizable deficit year, with investment expected to stay firm. But here's where I want to add the nuance that a lot of silver commentary leaves out. Not every green energy headline is automatically silver bullish in a straight line. Recent reporting and industry data show that solar manufacturers have been aggressively reducing silver use and pushing toward substitution where they can because silver got too expensive. Industrial demand hit a record recently, but forecasts for this year also reflect some softening in solar-related use because thrift is real. So the long-term silver case is still alive, but the lazy version of the case, where every extra solar panel means the same silver load forever, that version needs updating. To me, that does not weaken the thesis. It sharpens it. Silver does not need fairy tales, silver just needs reality. Reality is that industrial use is broad, not singular. Reality is that deficits have persisted. Reality is that above-ground inventories are not infinite. Reality is that if gold keeps getting absorbed into reserve strategy and silver keeps sitting at the intersection of monetary stress and industrial necessity, then over time, silver remains one of the most explosively misunderstood markets out there. Now let's zoom out to the dollar question, because this is where people usually swing from denial to fantasy. On one side, you have people saying de-dollarization is fake because the dollar is still dominant. On the other side, you have people saying the dollar is basically finished by next Tuesday. I do not think either side is being serious. The latest reserve data still show the dollar in the mid-50s as a share of disclosed global reserves. That is still a huge position. Still number one by a mile. Still central to settlement, trade, and funding. So anyone telling you the dollar already collapsed is just not reading the board. But at the same time, the direction of travel has not been hard to see. Gold's reserve roll has been climbing. The renminbi share, while still small, has been inching up. Central bankers in a recent survey said geopolitical tension is now their top short-term concern by a wide margin, and a meaningful share said they are considering more gold. That does not describe a world becoming more comfortable with the old setup. It describes a world hedging against it, and then you add the plumbing story. A lot of people obsess over the big headline version of this, some new currency, some dramatic announcement, some overnight replacement event. I think that misses the point. The important part is often the payment rails, settlement channels, bilateral workarounds, digital links, and quiet arrangements that let trade happen outside the traditional path, one deal at a time. The Bank for International Settlements has already said mBridge reached a minimum viable stage. And Reuters reported earlier this year that India's central bank proposed linking digital currencies among BRICS members to make cross-border payments easier. That is not the same thing as dethroning the dollar tomorrow morning, but it is evidence that the architecture is being tested, not merely imagined. That is why the India angle matters too. Recent reporting confirmed India resumed buying Iranian oil for the first time in 7 years, with officials saying there were no payment problems. That is not a trivial detail. It tells you two things. First, necessity changes behavior faster than speeches do. Second, when energy security is on the line, countries become much more creative about how they source, settle, insure, and explain what they are doing. And once those channels are built, they rarely disappear completely just because the immediate panic cools off. So could this conflict accelerate de-dollarization? Yes, in the sense that every episode of sanctions pressure, reserve anxiety, shipping stress, and reconstruction need gives countries another reason to diversify. But I would frame it carefully. This is not a movie scene where one missile strike destroys the dollar. It is more like another crack in a very old wall. One crack alone does not bring the house down. But if the wall has already been taking pressure for years, every new crack matters. And that brings us to another piece most people are not thinking enough about, which is rebuilding. Let's say regional energy and industrial infrastructure takes repeated damage over time. What then? Well, who has the steel, the heavy equipment, the refining components, the manufacturing depth, the shipbuilding, the industrial inputs, and the willingness to finance reconstruction without giving a lecture first? That is where the geopolitical map can change quietly after the bombs stop. Because reconstruction is not ideology. Reconstruction is materials, engineering, labor, and time. That is also why U.S. treasuries do not solve every strategic problem, even if they remain hugely important financial instruments. You cannot literally rebuild a damaged plant with a bond certificate. At some point, somebody has to ship the transformers, the valves, the pumps, the steel, the plastics, the specialist components. And the country or bloc that can provide those things at scale can gain influence that does not show up immediately in the daily market close. Now, before we go further, let me ask you this. Do you think this remains a temporary scare that gets papered over with diplomacy? Or do you think the damage already done to energy flows and trust is bigger than the headlines are admitting? Let me know in the comments. My own view is that the next key issue is not whether every dramatic threat becomes reality. It is whether enough friction remains in the system that inflationary pressure reappears before policymakers have regained control of growth. Because remember, central banks are already in a difficult spot. The Federal Reserve reiterated in March that it still seeks 2% inflation over the longer run and explicitly said the implications of Middle East developments for the U.S. economy are uncertain. That is central bank language for, we know this can hit both sides of the mandate and we do not control the geopolitics. If energy stays sticky, rate cut hopes can get pushed back. If growth weakens at the same time, you get a nastier mix. And that is exactly the kind of environment where both equity complacency and bond complacency can get punished. We are already seeing that kind of repricing in pieces. Some banks have trimmed equity targets because conflict-driven oil risk clouds the outlook. India's central bank held rates steady today and pointed directly to rising oil-related uncertainty. The point is not that every central bank is panicking. The point is that the inflation-growth trade-off gets uglier when energy becomes geopolitical again. So if you are trying to think clearly about what happens next, I would separate it into 3 time frames. Very short term: headlines, retaliation risk, shipping risk, futures volatility, policy jawboning, and possibly violent moves that reverse just as fast. Medium term: physical supply tightness, higher freight and insurance, stress in diesel and feedstocks, selective shortages, delayed rate relief, and renewed safe haven demand once forced liquidation burns off. Long term: more reserve diversification, more experimentation outside the dollar, stronger demand for politically neutral collateral, persistent strategic interest in gold, and a silver market that stays structurally sensitive because it sits in both the monetary lane and the industrial lane. And if you're successful, share your success story in the comments so others can stay motivated. Sometimes the smartest move is not chasing the next dramatic candle, but making sure your assumptions still match the world that actually exists right now. Now, what should regular people actually do with all of this? First, keep your head. Panic is not a strategy. Second, stop confusing being early with being wrong and stop confusing volatility with thesis failure. If you own metals, understand why you own them. If your whole thesis was one more headline and instant riches, that is not a thesis. That is a mood swing wearing a thesis costume. Third, think in layers. Financial resilience matters. Liquidity matters. Hard assets can matter. But practical resilience matters too. Community matters. Skills matter. Relationships matter. In unstable periods, the most undervalued asset class on earth is trustworthy people who answer the phone. Fourth, do not let the screen colonize your brain. There is a difference between staying informed and becoming emotionally hostage to every hourly rumor. Online arguments are not the world. They are just the loudest corner of it. And finally, do not root for total systemic rupture just because you think your portfolio would like it. A genuine breakdown in pricing, shipping, payments, or energy distribution is not some clean jackpot scenario. It is messy, it is political, it is unpredictable. It can produce rules, restrictions, and outcomes that nobody cheering for chaos has really thought through. So, putting all of this together, what do I think? I think the danger is real, but the cartoon versions are wrong. I do not think every apocalyptic threat should be read literally as an immediate blueprint for total destruction. I do think visible force can be used to restore lost credibility. I do think retaliation remains highly likely whenever visible force is used. I do think the biggest market effects may come less from one spectacular strike and more from repeated pressure on energy arteries, petrochemicals, shipping, insurance, and trust. I do think food and fertilizer risk is real, especially for more vulnerable parts of the world, even if richer countries first feel it mostly through prices. I do think gold's long-term support remains intact because the reserve story is bigger than this week. I do think silver remains compelling, but I would rather own the honest version of the story than the exaggerated one. And I do think we are living through another chapter in a slow global rearrangement that will probably look obvious in hindsight and confusing while it is happening. So watch the next headlines, yes, but do not stop there. Watch the tankers. Watch the official selling prices. Watch insurance costs. Watch central bank language. Watch reserve behavior. Watch whether gold keeps getting accumulated on weakness. Watch whether silver holds up after the fear spike passes. Watch whether alternate payment channels keep expanding quietly in the background. That is where the deeper story lives. And one more question before I wrap up. If this turns out to be only a temporary pause, what do you think breaks first on the next round? The market narrative, the energy plumbing, or confidence in the policy response? Take care of yourselves, take care of each other, and I will see you in the next video. And just so we're clear, this is for educational purposes only. I'm sharing analysis and perspective, not telling you what to buy, what to sell, or how to manage your money. Those decisions are yours, and they deserve your own homework.